So I think we're going to have higher highs and higher lows of inflation than we had in the prior decade. That's how I would describe a secular inflation. Um, and, kind of a major thing I've been pointing out is, so questions I got over the past couple years were, are they going to get inflation back down to 2%? And my answer has generally been, I don't know, but I don't think that's the right question. I think the right question is, what's going to happen with inflation the next time we have an upcycle in PMIs, for example, like Manufacturing Purchasing Managers Index.
What if I told you inflation is about to skyrocket to levels we haven't seen in decades? And that traditional safe haven assets like gold and Bitcoin could potentially see massive price surges. Renowned analyst Lyn Alden is sounding the alarm bells on a looming period of secular inflation with higher highs and higher lows than the last decade. She warns that the true test of runaway inflation will come during the next economic upswing. But it's not just inflation you need to worry about. Alden believes the strength of the U.S. dollar itself is at risk due to unsustainable fiscal policies and ballooning government deficits. In this eye-opening interview, Lyn Alden maps out why traditional tools like interest rate hikes may be powerless to stop the coming inflation tsunami. She also shares her bold price targets for gold and Bitcoin over the next 18 months as investors flee to hard assets. You won't want to miss her uncensored insights on the pivotal financial forces reshaping our economic future. Watch the shocking interview clips now.
Because I think that's the real test. You can get inflation down temporarily if you're willing to have a recession, if you're willing to disinflate enough. And that's kind of the pseudo cycle we've been on. It's obviously been offset by fiscal, as we've been talking about. So they've not gotten it down to 2%, but they have muted it significantly. We're starting to see early signs of PMI reacceleration, kind of rotation in what sectors are doing well. And so I think the big test is, if we get an upcycle in PMI, what does inflation do? My expectation is that inflation goes up or stays sticky when we get that next PMI rise. And so it's not a matter, could they touch 2% sometime this decade? Sure. But the question is, can you sustain there and have another cycle of growth while still sustaining there? And I think that's the much harder thing. And so, because I think this is going to be a more energy intensive cycle, I think we're going to be more linked to what happens with energy than we have been in say, the prior 10 years or so. And so I think my expectations, higher highs and higher lows compared to what we had in, say, the 2010s decade. I think as long as, so we've been in like a consolidating liquidity range for quite a while. My expectation is that over, call it 18 months, we break out of that. Watching this kind of gold consolidation, it kept banging its head around the all-time highs of 2000 and change. My view was, I don't know when it's going to break out, but once it breaks out, I think it's going to have legs to it. I think we're in the middle of that move now. And I think it's, it's one of those things you don't want to overthink it. Like, it can get near-term overbought and people are gonna be like, it's going to correct, and it absolutely might. But it's like, it's been in a bear market since 2011. It's been in a consolidation for 3 years. So I do expect a pretty significant run here. For Bitcoin, most of the indicators that I track point to being fairly mid-cycle in terms of the bull run. And so I still think the next 18 months look favorable for the asset. Again, it tracks global liquidity pretty well. The on-chain indicators can, show us, for example, how much long-term holders are selling into current strength. Because even though obviously Bitcoin supply is constrained, if the price goes up, 3x or 5x in a fairly short period of time, you generally see some of those older coins start to come to market and start meeting that new demand. And we've seen some of that, but so far we've seen less of that in this cycle than in prior cycles. And so I still think my expectation is there's room to run, both from the liquidity side being fairly constructive, so that should help demand. And I still think that there has to be a higher price to unlock some of these older coins to meet that demand. And so I would be surprised not to see six-figure Bitcoin over the next 18 months. Obviously, anything's possible, but I'm bullish on both gold and Bitcoin in that time frame.
We are entering a period of secular inflation characterized by higher highs and higher lows compared to the previous decade. This departure from the relatively low and stable inflation environment of the 2010s is driven by a confluence of factors, including energy dynamics and shifting economic cycles. One of the key factors influencing inflation, according to Alden, is the energy intensity of the current economic cycle. As the global economy becomes more energy dependent, the relationship between energy prices and inflation strengthens. Consequently, the path of inflation will be more closely linked to developments in the energy sector than it has been in the recent past. As the global reserve currency, the strength and stability of the U.S. dollar are closely watched by investors and policymakers alike. Alden's commentary underscores the increasing significance of the treasury market and fiscal deficits in determining the dollar's trajectory.
I think the funny thing is that because we're, kind of largely in fiscal dominance now, I think that the emphasis on the Fed is in many cases like backward looking, that the Fed has been a bigger source for markets for a long time. But as we kind of enter this fiscal dominant environment, I'm increasingly less interested in what the Fed does around the basis point margin, and more interested in what's happening with the treasury market, more interested in what's happening with the size of fiscal deficits, and those kind of more structural things. So to the extent that the Fed, cuts rates a little bit, or if they even add some interest rate hikes to it, it's not really the answer in my view. I think basically the large structural fiscal deficits are a bigger factor. And ironically, if they try to get down inflation by increasing interest rates, they're going to blow out the fiscal deficit even more. And so that's the lever that's different from the 70s, but closer to the 40s. And so for me, it's looking at, what are tax receipts going to be like? So for example, now, because 2023 assets are pretty good, asset prices, we should expect decent tax receipts here, which ironically could narrow the deficit a little bit, which could give us, kind of a somewhat weaker performance in 2024 for at least some of these, like say, mega cap assets.